Well, we closed below 3,900 yesterday, and we're below it again today, 38.47. Here with his take, professor at the Wharton School of Finance, Jeremy Siegel, joins us now. It's great to see you and to have you, Professor Siegel. I know you've been really fired up lately about the Federal Reserve. So now we had this meeting. We got the message from the Fed and, frankly, the ECB that they have a lot more work to do, and the market doesn't appear to like it. What's your take?
Sarah, I think the Fed is making a terrible mistake. Their plan, their dot plot is way too tight. Inflation is basically over, despite the way Chairman Powell characterizes it, and we could go into that if you want. I say over 90% is over. And with the bulk of monetary policy, as he himself admits, is yet to be felt, I see no reason to go any higher than we are now. In fact, I wouldn't have gone as high, but it's a done deal, certainly what happened earlier this week. But the talk of going higher and staying high through 2023, I think, would guarantee a very steep recession.
So first, I just want to say I do always listen to you, especially on inflation, because you were very early and very out front on the fact that we have an inflation problem in this country, and the Fed was very late on this fact. So I pay attention when you say inflation is over, but I don't see that in the data. If you look at what's happening with services prices, if you look at what's happening with wages, if you look at food, I get rent is a lagging thing, so we can put that aside. But where's the evidence that inflation is over?
Okay, and you mentioned rent, and in fact, I think Zillow came out with a headline today saying the biggest drop in rent since in the last month that they just recorded in their history. And of course, we know in the government statistics, we still have a big jump and will for another 6 to 8 months. Powell has admitted it, that prices are going down. We won't see it. But let's talk about wages, because that's really important. He fears wages as an inflationary force. Well, first of all, wages since the pandemic have not matched the increase in prices. The real worker wages have gone down. It's hard for me to see they're pushing inflation up when they don't even match inflation. You know, Sarah, over time, over the post-war period, wages have gone up 2% on average above inflation. Since the pandemic began, we should be 5% higher instead of lower. Secondly, Chairman Powell mentioned in his news conference about a structural shift. People are not working as they did now, and that could, really change the nature of the labor force. It is not the Fed's job to suppress the economy because there is a structural supply shift. They take care of aggregate demand, not shifts in supply. I mean, Chairman Powell was very clear when he misrepresented the inflation we had a year and a half ago as being supply-induced and say, we're not going to act against supply-induced inflation. Well, if people don't want to work, then firms have to offer higher wages in order to induce them to work.